Have you ever looked at your paycheck, seen how much was taken out in taxes, and wondered, how do rich people legally pay less than I do? It feels unfair. You work hard, you earn money, and before you even touch it, the government takes a cut. Meanwhile, you hear stories about millionaires paying lower tax rates than teachers or nurses. So what's going on? Here's the truth. It's not about cheating the system. It's about understanding how the system is built. And the tax system is designed differently for employees and for owners. Let's break this down. If you're an employee, your income is simple. You work, you get paid, you get taxed. That's it. Your taxes come straight out of your paycheck before the money even hits your bank account. You don't control much. You can't deduct your commute. You can't deduct your lunch. You can't deduct your apartment rent. You earn first. You get taxed second. You spend what's left. But wealthy people, they usually don't earn money the same way. They build businesses, they own assets, they invest, and that changes everything. Here's the first big difference. Business owners get taxed on profit, not revenue. Let's say a business makes $300,000. That sounds huge, but if the business has $200,000 in expenses, salaries, rent, software, travel, they're only taxed on the remaining $100,000. Revenue minus expenses equals taxable income. Employees don't get to subtract their living costs before paying taxes. Business owners do, and that's completely legal. Second difference, rich people often earn through investments. Stocks, real estate, private businesses. Investment income is often taxed at lower rates than regular salary. Why? Because governments want people investing money into the economy. So long-term capital gains, money made from selling investments, are typically taxed lower than paycheck income. That's not a loophole, that's policy. Third, the wealthy borrow instead of selling. This one surprises most people. If someone owns $5 million in stock, they could sell it and pay taxes. Or, they could borrow against it. Loans aren't income, so they get access to cash without triggering taxes. Their assets keep growing, and they delay paying taxes. Again, legal. Fourth, depreciation. This is huge in real estate. Let's say someone owns an apartment building that makes money every month. On paper, the government lets them depreciate the property, meaning they can claim it's losing value over time. Even if the property is actually increasing in market value, that depreciation reduces taxable income, so they might collect real cash flow while reporting very little taxable profit. Perfectly legal. Now here's the part most people miss. The tax code wasn't written to punish workers. It was written to encourage behavior. Start businesses, create jobs, buy property, invest capital. The system rewards ownership, and most wealthy people are owners first, employees second. So what does this mean for you? It doesn't mean you need to be a billionaire, but it does mean this. If all your income comes from a paycheck, you'll likely always pay the highest effective tax rates. The more you shift toward ownership, even small things like investing, freelancing, or starting a side business, the more the rules start to change in your favor. That's the real difference. It's not about secret offshore accounts. It's about structure. Employees earn, then pay tax. Owners spend, then pay tax on what's left. That one shift changes everything. So next time you hear that the rich pay less in taxes, understand this, they're often playing a different game with different rules that were available the whole time. And once you understand the rules, you can decide how you want to play. If you found this helpful, stick around, because understanding money is the first step to keeping more of it.